Imagine holding a digital asset powering 1 trillion monthly AI interactions, generating real fiat revenue and mathematically burning its own supply, yet retail traders are completely ignoring the market structure. The contrarian insight here is that the future of AI isn't sitting in a massive, centralized server farm managed by big tech. It's fully decentralized, sitting entirely on local devices, and governed by a protocol that effectively pays you to use its compute power. The stakes right now are incredibly high. Venice and its native token VVV are sitting exactly at the 1618 Fibonacci resistance level. A rejection here means a brutal macro reset, but a confirmed weekly breakout triggers true price discovery into uncharted territory. I'm going to show you exactly where the liquidity gaps are and how I'm positioning my own capital. Right now, the broader crypto market is completely exhausted from endless narrative hopping and empty utility tokens. We have seen liquidity aggressively rotate out of these speculative hype coins and seek refuge in protocols with sticky, verifiable yield and real revenue. This is exactly why this breakdown matters today. Market sentiment is currently hyper-focused on AI, but it's heavily skewed towards centralized players that can arbitrarily ban developers, throttle bandwidth, or scrape your private corporate data. Smart money, the institutional capital that actually moves these markets, is actively hedging against this precise risk. They are looking for permissionless infrastructure that cannot be shut down. We are seeing a distinct shift in macro flow where whales are quietly positioning into decentralized compute networks. They are preparing for a world where inference is completely commoditized. But before we look at the exact load zones, the trailing stops, and the invalidation levels on our weekly chart, we need to thoroughly understand the fundamental catalyst driving this structural shift. What is actually trapping the circulating supply? Let's dive into the core architecture, because what the development team is building completely flips the traditional software-as-a-service model upside down. The fundamental thesis for Venice begins with absolute privacy. Their architecture ensures that your prompts remain 100% private at all times. All data stays strictly on your device, not on their servers. For a retail user, that's a very nice feature. But for a sovereign wealth fund, a hedge fund, or a massive global enterprise, it's a strict regulatory requirement. Institutions are terrified of the data scraping risks associated with public language models. Venice offers a localized architecture that completely solves this institutional data privacy bottleneck. But a good product does not automatically translate into a good token. This is where the tokenomics create a fascinating and aggressive supply shock. Venice offers multi-tier fiat subscriptions, such as their Pro Plus package for $68 a month. This pricing model grounds the protocol in real-world revenue, rather than relying solely on inflationary token emissions to survive. Fiat inflows from software subscriptions provide an incredibly stable runway. And here's the critical data point. Every single new Venice Pro subscription automatically triggers a $1 market buy and burn of the Venice token. At their current adoption rate, they are burning roughly $1,000 of VVV every single day. This is a hard, programmatic deflationary mechanism. You are looking at a traditional software subscription fee single-handedly creating a daily supply squeeze in the secondary crypto markets. Then we have the compute engine itself, which is driven by the DIEM token. Minting DIEM is driven by actual verifiable usage demand. You lock your staked Venice token to mint DIEM, and importantly, this action is fully reversible. When you burn DIEM, you unlock your Venice token. There's no forced dilution, there's no unbounded algorithmic issuance, and there's no fragile synthetic peg to unwind. If you remember the Terra Luna collapse, you know that whales absolutely fear algorithmic death spirals. The Venice structure proves that the reflexive mint loop is mathematically bounded by real compute utility. You get the upside of a reflexive token loop without the catastrophic failure mode on the way down. The adoption metrics backing this up are frankly staggering. In March, the protocol hit 1 trillion monthly language tokens produced across their web, application, and API interfaces. 1 trillion. That indicates parabolic product market fit. Yet when you look at the token distribution, the asset remains severely underowned by Tier 1 venture funds. With over 131,000 unique wallet holders, the token is widely distributed to the public, which significantly lowers the risk of single whale manipulation or sudden liquidity cascades. Furthermore, Eric Voorhees and the leadership team are holding a remarkably firm line on their monetary policy. They recently stated they are monitoring how the economics are working together and will be extremely cautious about any modifications. They refuse to dilute the staking requirements just because the token price has risen in fiat terms. For us as position traders and yield seekers, this means token scarcity is rigorously preserved. You don't have to worry about sudden parameter changes diluting your edge. To solve the issue of locked capital, they recently introduced wrapped staked VVV, which gives you instant liquidity with auto-compounding yields. This liquid staking derivative is transferable and collateral-ready, built on Lagoon Finance infrastructure. So, a previously illiquid asset can now be seamlessly deployed across decentralized finance. You can earn network emissions while simultaneously using the wrapped token as collateral for secondary yield strategies. The protocol is also quietly positioning itself as the foundational routing layer for the entire autonomous agent economy. They released Venice Skills, which consists of 19 simple markdown modules that drop seamlessly into any major agent runtime. Every autonomous AI agent deployed using these skills becomes a continuous, automated consumer of network inference. This ensures steady, programmatic yield generation for token holders. This mechanism completely alters the risk profile for institutions. You can buy $1,000 of DIEM on day 0, consume $1 of free inference on day 1, and sell your remaining DIEM back to the market on day 2. The compute effectively pays for itself. The tokenomics literally pay you to consume inference. Furthermore, DIEM is now officially live on the Coinbase application. This Tier 1 exchange listing acts as a massive liquidity funnel, bridging traditional fiat directly into the decentralized ecosystem and providing a zero-friction off-ramp for the compute token. Venice is also aggressively aggregating hyper-efficient models. For example, DeepSeek version 4 is available on their network at 1/20th the cost of Claude Opus 4.7. Lower model costs mean that autonomous agents can run 20 times longer on the exact same collateral. And they are not just doing text generation. Kling version 3 is now live, outputting cinema-grade video natively. High-density video generation burns through network credits incredibly fast, forcing aggressive DIEM consumption by power users. They also offer an uncensored version of the Mistral 24B model. Uncensored AI targets a highly inelastic demand sector that corporate tech giants simply refuse to touch due to compliance. It's a pure, unforkable moat. And when centralized giants arbitrarily ban developers from their APIs, Venice provides a permissionless wrapper. Your development pipeline survives via the Venice network, ensuring the network's yield distribution remains completely secure. So we have explosive compute demand, a daily fiat burn, and a highly restrictive staking environment. But how is this institutional alpha actually translating to the price action? Let's break down the weekly chart and define the exact price levels where this bullish narrative either accelerates or completely breaks down. Right now, Venice is trading right around $9, and it is sitting at an absolute critical pivot point. The price has been respecting a beautiful multi-month ascending trend line, which you can see as the white dotted line on the chart, since the ultimate all-time low at 95 cents back in November of 2025. We have seen a steady, methodical progression of higher highs and higher lows. This is the textbook definition of a healthy, sustained markup phase driven by spot accumulation, rather than leveraged retail speculation. Currently, price action is heavily supported by our key exponential moving averages. We are trading cleanly above the 10, 21, and 55 exponential moving averages, represented by the red, blue, and purple lines. The 10 and 21 period averages are acting as dynamic support, perfectly guiding the trend higher. But the absolute most important level on this chart right now is the 1618 Fibonacci extension. This Fibonacci grid is anchored from the major $4 swing high in August 2025, pulled down to that 95-cent macro low. That specific 1618 level sits exactly at $9.90, which perfectly aligns with the heavy psychological resistance of $10. We are testing this massive resistance zone right now. This is exactly where retail traders typically get trapped by anticipating the breakout too early and getting caught in a long squeeze. My personal position strategy here is strictly reactive, not predictive. I have defined two very clear load zones depending entirely on how the market makers decide to resolve this cluster of liquidity. My first load zone, highlighted by the upper green box on the chart, spans from $9 up to $11. However, and this is crucial, this zone is only activated under one very specific condition. I need to see a confirmed, high-volume breakout on the weekly candle closing above the 1618 fib level at $9.90. Following that weekly close, I want to see a daily chart retest of that $10 level, confirming it has flipped from macro resistance into new macro support. If we get that exact confirmation, I'll execute a strategic accumulation. The invalidation zone for this specific setup, which is my hard stop loss, would be placed at $7.80. I would only trigger that stop if a weekly candle clearly closes below it, which would indicate a liquidity fakeout and a severe breakdown in the local market structure. If the price gets rejected heavily at this current $9.90 resistance, we'll likely see a protracted pullback to test the ascending trend line once again. And honestly, after such an extended, uninterrupted run, a deep pullback would be incredibly healthy for the token's macro market structure. It flushes out late, over-leveraged buyers. If that rejection happens, my second load zone is waiting patiently between $4 and $6. $6 is our closest major support zone, as it was the critical breakout resistance broken 3 months ago. My invalidation level for this lower, deeper zone would be a weekly close below $3.70. When we talk about de-risking at resistance, my take-profit targets are mathematically mapped out using the Fibonacci extensions. Target 1 is $20, which brings us very close to the previous all-time high liquidity pool. Target 2 is $42, perfectly aligning with the 2618 fib extension. Targets 3 and 4 are major structural milestones at $100 and $180. My scaling methodology here is highly systematic. I'll be offloading my position heavily at Target 1 and Target 2 to secure risk-free profits. Furthermore, I employ a strict trailing stop system. If we achieve that $20 target, my stop loss immediately moves up to my entry price. If we hit $42, the stop loss moves up to Target 1. This methodology protects capital and ensures a stress-free ride during aggressive price discovery. We also need to pay close attention to the Fibonacci Relative Strength Index, which is the indicator located below the price action on the chart. It's currently sitting in extreme overbought territory, though it is still pointing to the upside. Now, in a true parabolic bullish phase, oscillators can remain mathematically overbought for many weeks, so it isn't an automatic or immediate sell signal. The standard rules often break down during price discovery, but it's still a glaring caution sign. It tells us that a mean reversion pullback is highly probable and, frankly, required for a sustained bullish continuation. The technical indicators are screaming that major volatility is imminent, which perfectly sets up our overall strategic approach. Synthesizing this programmatic fundamental supply shock with our defined technical setup gives us a very clear, data-driven edge. The absolute best-case scenario is a clean, definitive break of $10, forcing massive sidelined institutional capital to chase the asset as compute commoditization becomes the dominant crypto narrative of the year. The worst-case scenario is a broader macro market flush that drags Venice all the way back down to the $4 level. But as we just mapped out, that simply allows us to acquire the asset at a much deeper, risk-adjusted discount at our secondary load zone. My underlying thesis would only fundamentally change if major foundational models release hyper-cheap, natively decentralized application programming interfaces that completely bypass the need for Venice as an aggregator, thereby breaking the DIEM utility loop. But currently, absolutely no one is beating their combination of enterprise privacy and raw performance. And as a quick strategic pivot, my actual accumulation strategy has been slightly different lately. Instead of aggressively buying spot Venice tokens while the price is heavily extended, I have been utilizing my locked V-Arrow position on the Aerodrome decentralized exchange platform. By voting on the deepest wrapped Ether and VVV liquidity pools for more than 5 consecutive weeks, I have been farming Venice tokens at a very high annual percentage rate. It's a zero-cost basis accumulation strategy that completely bypasses the psychological stress of timing the top-tick entry. Let the weekly chart decide its next major move, while you simply sit back and passively compound your yield. So, in my honest opinion, Venice is successfully bridging real-world fiat subscription revenue into a programmatic deflationary token model, all backed by explosive, verifiable network demand. The weekly chart is compressing violently right at the 1618 fib resistance, presenting us with two highly defined, low-risk trade setups based entirely on how market liquidity reacts at that psychological $10 barrier. The retail market is currently pricing this asset like a speculative software token, but smart money is pricing it like digital utility bandwidth. If you found real value in this breakdown, please drop a like on the video and subscribe to the channel. It tells the algorithm that serious data-driven market analysis still matters in this space. If you want to move beyond just watching YouTube videos and actually see my real-time portfolio tracking, including my exact execution inside these specific load zones, consider stepping into the Pro Capital Vault. It is my private community right here on Discord. You get access to my weekly live strategy calls, my deep dive Sunday prep reports, and direct daily access to me and other veteran traders. Just click the join button directly below this video or use the access link in the pinned comment. Once you are inside, simply sync your YouTube account to your Discord profile to automatically unlock all the private strategy channels. Also, since the Venice infrastructure relies so heavily on open-source model routing, I highly recommend watching my last deep dive video on BitTensor, as their decentralized network architecture perfectly complements this exact macro narrative. You can click on that video right now on your screen. Remember, this entire analysis is for educational purposes only and is never financial advice. Capital preservation is your only true long-term edge in these markets. Stay disciplined, trust the data, and I'll see you in the next setup.